The Roth Conversion Ladder. How to build tax-free income before you hit 59 and a half. Most people who retire early think they're stuck. They've got money in a 401k or a traditional IRA, but they can't touch it without paying a 10% penalty until they're 59 and a half. So they either drain their savings account too fast, or they wait. And while they wait, every year that money sits in a traditional account, it's growing a tax bill they'll have to pay later. There's a strategy that solves this. It's called the Roth Conversion Ladder. It's not a loophole, it's not a trick, it's exactly how the tax code is designed to work, and most people have never heard of it. By the end of this video, you'll understand exactly how the ladder works, how to build one, and how to use it to create years of tax-free income before you ever hit 59 and a half. Before we get into the ladder, let's make sure we're on the same page about the two account types involved. A traditional IRA or 401k uses pre-tax money. You get a tax deduction when you put money in, but every dollar you take out in retirement is taxed as ordinary income. The IRS deferred your taxes. They didn't forgive them. A Roth IRA is the opposite. You contribute after-tax money, meaning no deduction up front, but once that money is in the Roth, it grows tax-free and comes out tax-free in retirement. Here's the catch with Roth accounts. Contributions can be withdrawn anytime, but earnings and conversions have a 5-year seasoning period, and for anyone under 59 and a half, there's an additional 10% early withdrawal penalty on earnings. The Roth Conversion Ladder exploits the gap between those two rules. You take money from a traditional account, convert it to Roth, paying income tax on it today, often at a low rate, and then wait 5 years. After that 5-year clock runs out, you can withdraw that converted money penalty-free, even if you're not yet 59 and a half. Do this once a year, every year, starting 5 years before you need the income, and you've built a self-sustaining ladder of tax-free withdrawals. Let me walk you through a concrete example so this becomes real. Say you retire at age 45 with $600,000 in a traditional IRA. You have no 401k from an employer, you're done working. You need roughly $40,000 a year to live on. Here's the problem. You can't pull that $40,000 from your traditional IRA without paying income tax plus a 10% early withdrawal penalty. That penalty alone costs you $4,000 a year. Over a decade, that's $40,000 gone, just to access your own money. Here's how the ladder changes that. In year 1, you convert $40,000 from your traditional IRA into a Roth IRA. You pay income tax on that $40,000 at your current marginal rate, but you don't touch it. You let it sit in the Roth. In year 2, you convert another $40,000. Same process. You do this every single year. Now here's where it pays off. In year 6, 5 years after your first conversion, that original $40,000 is fully seasoned. You can now withdraw it from the Roth completely penalty-free, even though you're only 50 years old, no 10% penalty, and because you already paid income tax on it when you converted, the withdrawal itself is tax-free. Year 7, you pull from the year 2 conversion. Year 8, the year 3 conversion. The ladder keeps paying. What you've built is a 5-year pipeline. The conversions you're doing today are funding your income 5 years from now. Once the ladder is running, every year a new rung becomes available. A predictable, penalty-free, tax-free income stream. And here's the key. If you're in a low-income year, which early retirees often are, especially before Social Security kicks in, you're converting money into Roth at a lower tax rate than you'd pay in a normal working year. You're paying 12% on conversions today instead of 22% or 24% later. That's the real tax arbitrage. The most important decision in building a ladder is how much to convert each year. Get this right, and you can keep your tax rate low for the entire ladder build period. Here's the framework. When you're retired early, before Social Security, before required minimum distributions, your taxable income is often very low. That means you have space inside the lower tax brackets that you can fill with Roth conversions. In 2025, the top of the 12% federal tax bracket is $47,150 for a single filer and $94,300 for a married couple filing jointly. If your other income, dividends, part-time work, rental income, adds up to, say, $10,000, you have roughly $37,000 of space left in the 12% bracket. That's your conversion ceiling for the year. Convert up to that amount, and every dollar is taxed at just 12%. Convert more than that, and the excess spills into the 22% bracket. That's not necessarily wrong. It depends on your situation, but it changes the math significantly. A tax professional or fee-only financial planner can help you model this accurately for your specific situation, especially if you have investment income, a part-time business, or a spouse's income to factor in. There's one more angle worth understanding: how market conditions interact with the ladder strategy. When you do a Roth conversion, you're taxed on the value of the assets at the time of conversion. If the market is down, say your traditional IRA is worth $400,000 instead of its normal $500,000, and you convert a portion of it, you're paying income tax on a lower dollar amount for the same number of shares. When the market recovers, those shares grow inside the Roth, completely tax-free. You essentially converted at a discount. This is why market downturns, while uncomfortable, are often the best time to accelerate Roth conversions. You're buying future tax-free growth at a lower cost. This isn't market timing, it's tax efficiency. For anyone building a ladder, keep this principle in mind. A significant market pullback during your conversion years is an opportunity to convert more than you otherwise would, at a lower tax cost, with the same long-term upside. The chart on screen is just illustrative. The logic applies regardless of when you're watching this, because market cycles repeat. Let's bring this together into what you can actually do with this. The Roth conversion ladder is designed for two types of people. First, anyone planning to retire early, before 59.5, who has significant money in traditional retirement accounts. Second, anyone currently in a low-income year, between jobs, transitioning careers, taking time off, who can convert at a lower rate than they expect to face in retirement. 3 mistakes to avoid. Let's recap. The Roth conversion ladder is a multi-year strategy that moves money from a traditional retirement account into a Roth, one annual conversion at a time, so you can access it penalty-free after 5 years, even before you're 59.5. The key is starting 5 years early, sizing conversions to stay in the 12% bracket, and using low-income years, including down markets, to your advantage. It's not a shortcut, it's planning, and the people who benefit most are the ones who start years before they need it. If this breakdown was useful, drop a comment below. Which retirement or tax strategy should we cover next? Backdoor Roth, 401k mega backdoor, tax loss harvesting. Let me know what you want to understand. Subscribe if you're not already. We cover this kind of breakdown every week. This video is for educational purposes only and is not investment or tax advice. Tax rules change and your situation is specific. Consult a licensed tax professional or fee-only financial advisor before making any conversion decisions. See you in the next one.